So the objective on the channel is to help you build profitable banking relationships, develop partnerships with your bank that increase your net worth. In this particular video, I'm going to be giving you a unique perspective as an actual banker on how I was able to solve a complex problem for my client that gave him significantly better returns on his money while simplifying his banking relationship. I want to do this because I want to give you insight on what it looks like and what your banker should be able to provide you. When you bank somewhere, you're looking for maximum value. The bank's going to find a way to get every bit out of you that it possibly can. And the root of this channel is to help teach you how to balance out that partnership, how to not be transactional at the bank, but to build a partnership. So while the bank's making money, you're making money as well. You should be getting much more value out of your banking relationship than you ever have to pay for it. So I'm going to give you a perspective as a banker of what you should be able to expect from your bankers at your financial institutions, the way they should be able to solve problems for you. And that way you can know you're getting the most value out of that relationship, or you know how to get away from that institution or at least that banker or branch if you're not getting these kind of solutions and advancements in your wealth and your net worth. So the first thing I want to give you context on is who was the client. The client was about an 84 or 85-year-old retiree, about a 60-plus year working career. He worked 3 different careers in his time. Quick side note, these guys from these older generations are cut from a different cloth. I know people today that can't keep a job for 6 months. This man worked 3 different careers and had a retirement from 2, meaning he worked 20-plus years in two different fields. But anyway, aside from that, banking relationship-wise, he clearly had a wife. His wife passed away. She managed the majority of the finances. He had about 5 different deposit accounts with us, and he had a collective relationship of over $300,000, somewhere to the tune of $320,000 in total balances with us. We have been working with this client for years. So we're talking 3-4 years easy, coming in with various transactions. We helped him when his wife passed away, and he just kind of came in and developed more and more trust, to bring in, incrementally bring in more and more of his needs. We were able to consolidate a few accounts when his wife passed away, but he still ended up with 4 or 5 accounts left and became troublesome for him. So that leads me to the problem. What was the issue? We know the client was 80-plus-year-old retiree, long working career. He had multiple assets outside of our institution. His net worth was probably north of $1 million, but in-house he had about $320,000 at the institution that I work for. So once his wife passed away, the problem, he needed to simplify that relationship. And he needed to simplify because he was starting to get to a stage in his life where he was having trouble figuring out where he was paying his bills from, out of which account, where the money was going. He was starting to have issues, which account am I doing my business out of? What transaction was that I conducted? What was that cashier's check for? Understandable things at that stage in life, especially when you weren't used to managing your money in the first place for decades. So once we figured out the problem, we needed to understand, what did the solution look like? That was my question for him. I understand you're at this stage in life, you're trying to simplify things, you're trying to get things condensed. You're not used to handling your finances, and the person in your life who did is no longer with us. What does a solution look like for you? So his response in short was, I need to be able to simplify my accounts so I know exactly where I'm paying my bills from. And I need to be able to separate the majority of my balances to get the maximum interest I can earn. That wasn't his exact words, but that's what it broke down to. So that having been said, of the 4 to 5 accounts that he had, it's important for you to understand particularly what he had so you understand how I had to configure a solution. That's the 4th point. How did I take that information and come up with a solution for this client? So he had about 4 or 5 accounts. He had 3, maybe 2 to 3 checking accounts, a savings account, and a CD. Out of the 320, maybe about 260 was in a CD, maybe another 30 or 40 in the savings, and the remaining 20 or 30,000 that's left in that equation was broken out between 2 to 3 other checking accounts. You can imagine at 85 years old, how that probably was cumbersome to navigate all those different buckets of money. So we had a challenge. The CD was maybe about a 9 or 10 month CD, and he had about 8 or 9 months left on it. And this is $260,000 we're talking about. He was getting maybe 2.5% on that CD. Don't scoff at the rate, just stick to the story, all right? That still was going to earn him maybe another $4,000 or $5,000 left in that term of that CD. So he wanted to consolidate now. And the only way to get that done was to risk breaking that CD, which was going to cost him the interest based on where he was in the term of the CD. For those of you who may not be familiar, certificates of deposit or deposit products, FDIC insured up to $250,000. They're guaranteed a fixed rate of income for a guaranteed window of time. It could be 3 months, 6 months, a year, 5 years, 10 years. Whatever the window of time you agree on, the bank guarantees you that interest rate for that duration of time. Usually earns better than the average savings account, but you are giving up liquidity. So hopefully for those of you who weren't aware, that's how the CD works. Because he was still deep in the term of his CD, meaning that he, again, maybe had a 10-month CD and he had about 8 months, 7 or 8 months or 9 months left on it, he was going to have to pay a penalty to break that CD. The penalty was going to be significant because it's earlier in that contract. The way the penalty works is the longer the duration of the contract you fulfill, the lower the penalty is. So your penalty is going to be the worst day 1 or day 2 of that CD. It's going to be the least day 1 or day 2 before the maturity of that CD. Comment down below if that makes sense. Now, let's get on to the solution. He was going to need to break that CD if I was going to fulfill his wish of consolidating and simplifying his accounts. I also had the burden of trying to figure out how am I going to still protect your earnings. You're getting an okay return on this money. It's not great, but you're still getting 4 figures a year risk-free on this money. I have to find a way to consolidate these 4 or 5 accounts, get you into a functional checking account where you can spend what you need to spend and separate the vast majority of the rest of that deposit off into something that still gives you a guaranteed return, because you're at an age where you're not going to jump into the stock market, generally speaking. You're looking to get a equal to better return on the to what you're used to in the CDs that you've normally been in, with rates a bit higher than they've normally been the last few years at the time of this recording. And essentially, I have to figure this out while you have to pay a penalty. So that means you have to take a loss on the consolidation of these deposits. So that left me a pretty interesting problem to have to solve. So because of this information, what I basically did was I had to match a product that was going to earn him equal to better interest and make the penalty make sense while still guaranteeing him the earnings. So the checking account portion was simple. Close the rest of the deposit accounts, figure out how much he needed in his checking account to maintain his bills, make sure that he was getting his direct deposits from his retirement in so he can continue to get his income in one place and pay out of one place. Not a big deal. We were able to get that done pretty simple. But I had to figure out what to do with this CD. He wanted to consolidate $15,000 or so in his checking accounts with his recurring direct deposits coming in. Fine, not a problem. That left around over $300,000 that he still needed to put up and earn a decent return on, guaranteed. So product knowledge kicks in at this point in time. As the banker, I don't expect you as the client to have to know how any of this works. I just need you to trust me enough and understand what I'm breaking down for you. So product knowledge from me says he's in a CD. Breaking it is going to cost him between $4,000 and $5,000. He normally has been making around $600 to $6,500 the last couple of years on his CD. Now I need to figure out how to get him a better rate and still get him the peace of mind of the CD. So I realized at his age, given his circumstances, and with the rest of his financial picture, given the fact that he had over $700,000 in outside assets, as well as multiple properties of rental real estate, and he had 2 different sources of retirement income coming in. So what that basically means is the money we were holding was going to be some of the last money he'd need to touch if he ran into any kind of emergency. He had 6, nearly 7 figures in capital that he can tap without having to touch what he had with us. Great. So now that I understand that, Now I need to figure out the product. What worked for him at his age, stage, and given financial situation was a fixed annuity. A fixed annuity is going to be an insurance product. What this basically does is give you a guarantee rate, protects your principal, and gives you windows of times of 3 to 5 years most commonly. So unlike his CDs that he was doing at 6 to 10 or 12 months at a time, in an environment where rates are dropping at the time of this recording, I needed to find something that can secure him into a decent rate and do it for a longer duration of time, because he wanted simplicity and to consolidate and still get a good return. The fixed annuity made brilliant sense. He's going to get a longer duration of time than he would get on his average CD. The rate actually turned out to be nearly double. He was getting around 2.5 on his CD. We got him over 4% on the annuity with a solid insurance company. The principals guaranteed insurance products, insurance fixed annuities are guaranteed by the state. So they're not FDIC insured. So we can't say that it's guaranteed in that way or covered in that way, but it is insured and backed up by the state. Insurance companies tend to be very stable because unlike banks, they cannot operate on fractional reserve lending. That means insurance companies have to cover dollar for dollar, unlike banks that can have $10 on deposits and lend out over $100. Hopefully that makes sense. So they're very stable companies. They're very stable products. So a fixed annuity worked for him. He's over a certain age that makes fixed annuities make sense. If you're younger than retirement years, annuities usually don't make a lot of sense for tax reasons. He's well into his retirement years. So benefits of the fixed annuity really quick. Longer term, higher rate, guaranteed principal, guaranteed rate, tax deferred, and death benefit, all on one product. His CD did not have a death benefit on it. It was only going to be about 10 months at a time. The rate was going to continue to likely decline if rates continue on the path they were going. And it means he's going to have to come in once a year and constantly figure out what to do with this money. We gave him the 3 to 5 year option. Once I presented to him, hey, listen, you're going to lose about $4,000 to $5,000 breaking this CD, but I'm going to put you in a guaranteed product that you're going to be able to get in the first year. You're going to earn over $11,000 to $12,000 on. And you're going to continue to earn that for the next 3 to 5 years, depending on the term you select. I'm going to be able to add a death benefit for you. You won't have to worry about this money for 3 to 5 years, and it's tax deferred growth. So you don't have to worry about taxes for 3 to 5 years. Unlike your CD, where you're getting a tax document once a year for the interest. He loved it, needless to say. So what ended up happening is, even though he took a loss on the CD of $4,000 to $5,000, he's going to earn in the same 1 year window of time nearly $12,000 or 12 plus. And he's going to do that guaranteed for 3 years without having to worry about taxes, without having to worry about coming in once a year to alter the product or alter where he puts the money. And he has a beneficiary in place if something happens to him at his tender age of 84 to 85 years old. So this is an example of how you solve complex problems that you may have in your financial life. And having a good quality banker at a quality institution, this is the type of solution that can be presented. You can go in with a complex problem that's driving your finances into the ground and giving you serious financial stress in your life, and turn around and come out making even more money with even more stability for longer durations of time. Your situation could look totally different, but this is the more of the story of how you turn your relationships with banks into partnerships and profit from them. The bank loves it because you're relationship banking on a deep interconnected level. The bank is still going to make their money on the products that you're using, but you're still coming out ahead. The annuity didn't cost him a penny. There's no fees for it. He has great guarantees. He has legacy planning built in, great fixed rate. He's making more money year one, and he has a guarantee of that earning for the 3 to 5 years, which he selected a 3 year in this case. This is what this can look like. Comment down below and let me know what you took away from this story time. Let me know if you're working with a banker and the type of solutions or problems they've been able to solve for you, or solutions they've been able to provide given your financial situation. Let me know if now this inspired you to work on getting a banker, now that you see how this can potentially work. Comment down below and let me know your thoughts. So all my pioneers, welcome back. To my new viewers, welcome in. I want you to like, comment, share, subscribe, support the channel so the channel can continue to support you. Get in the description section down below so you can tie in with me on Instagram. Also, you can tie in with me on TikTok at this time. And I want each and every one of you to stay focused, stay in motion. I'll see y'all soon.